Good morning for those of you that have joined us. It's great to see that once again we've got numbers arriving. I think they're coming thick and fast, which is good. Anyway, I intend to introduce Jeremy in a second. Just a couple of bits just to cover off. The first thing being that this, should you not already know, is the second of our series of three autumn webinars from Blue Sky. Last week's session was on pension basics, and whilst this week's session turns the technical aspect up a notch on the dial, I hope it's not too technical for you. It's certainly not aimed or designed with that in mind. Obviously, the session is about letters of instruction. So before I introduce Jeremy, just a quick note to say, and in fact invite questions from you all as the session proceeds. Now, you do this by clicking within Zoom the Q&A tab on your bar, and myself, I'm Rob Starling, and Jack Thompson will be hiding behind the scenes trying to answer as many of those questions as we can humanly do whilst Jeremy carries on talking through the presentation. We'll probably look either to respond to you individually via the Q&A, or if we think it's a really cool question, that's not to say that they're not all cool, of course, we will maybe open out to the wider group. Time permitting, I know Jeremy's going to try and see if he can finish maybe 5 minutes, 10 minutes before the end of the session, but look, let's see how he gets on. We might even open things out and do maybe a live Q&A at the end. The session will be recorded, so it can be posted on the website. I think it might even be emailed out afterwards. On the matter of recording, we were conscious that in the last session there were a few comments that maybe the sound was a bit patchy. So with great expense to Blue Sky, we've gone out and bought a fancy microphone, and today is its debut, so fingers crossed all goes according to plan. Regarding today's speaker, Jeremy Jackson, he's a co-owner of Blue Sky. He's a resolution member, a chartered financial planner indeed. He's a fellow of the Personal Finance Society as well. He's been at Blue Sky for almost 10 years now, which of course means plenty of exposure to all things finance as far as divorce is concerned. And he most certainly knows his way about a pension sharing order and the good and the less good of letters of instruction. Jeremy, over to you.
Good morning to everybody. Thanks for setting aside the time to listen into our webinar today. So I'll just load up the slides. Just bear with me just for 1 second. He says, right. So once again, we appreciate you for making space for this presentation in your busy diaries. I know how you're all very busy at the moment, so thanks for giving up the time. Before we go through the agenda and learning objectives, a couple of initial points to make, I think. Firstly, I'm aware that in last week's webinar we didn't leave much time for Q&A, so as Rob mentioned, we will try and leave a few minutes at the end of the session to answer any questions that you have. Secondly, I also appreciate that for some of you, much of what we're covering today will be familiar. However, based on some feedback received earlier this year after we did our spring webinars, we wanted to take things right back to basics. So without further ado, let's work our way through today's agenda. So who are Blue Sky and what do we do? We'll just spend a couple of seconds on that. Secondly, letters of instruction. What are the key questions that I should ask? Letters of instruction. Which questions are perhaps unhelpful to ask? And finally, how to get further help. So apologies to our regular viewers for repeating this slide, but it is worth reiterating a couple of points here. Firstly, we are financial planners and not actuaries, although we are, of course, pension on divorce experts. Our day job is presenting complex matters to our financial planning clients in an easy to understand manner. We think our pension sharing reports reflect our aim to present complex information in the same fashion, and we are regularly complimented on our ability to do this. Secondly, we have been producing pension reports for over 20 years. Currently, we receive around 50 quote requests a month, but because we want to control our workflow, we typically do around 10 to 15 reports per month. Having checked with the team manager before we started today, I'm pleased to tell you all that we are actually meeting our turnaround time promise of 6 weeks after receiving all of the pension information from the schemes in question. You will also note from looking at the slide there that Rob, who you just heard from, is a resolution accredited specialist, one of only around 30 in the country. So right, let's move on to the wonderful world of pensions then, and hopefully the screen that you can see in front of you doesn't bring you out in hives. I think that I'd be stretching it somewhat to say that all the advisors here at Blue Sky find pensions exciting. However, keeping up our knowledge is a challenge, and for better or worse, one that we quite enjoy. We love to help our clients make the most of current pension rules. In the same way, in our capacity of PODES, we want to apply this logic to divorcing couples to help them make good decisions with their pensions. I've been working in the pension industry for 25 years now, and if I cast my mind back to where I started, having just come out of university, having done a history and politics degree, I can remember trying to get my head around a myriad of terms that I've never come across before, such as contracting out, with profits and guaranteed annuity rates. Many of those terms have all but disappeared, only to have been replaced by other jargonistic phrases such as drawdown, lifetime allowance, and pension input periods. Those of you that were on the webinar last week with Mike will know that a little bit of pensions knowledge can go a long way, and even knowing the basic differences between DC and DB schemes and private sector and public sector schemes can be extremely helpful. I also wanted to drop a sympathetic note before I proceed, before we go into the main part of the presentation. So pensions are complex, it's a fact. New and challenging things around pensions arise all the time, and government constantly changes the rules, sometimes drastically and without warning. Note this year's budget, which abolished the lifetime allowance. Nobody saw that coming. Therefore, I can only imagine that some of you feel intimidated by this subject. So here's a few points. Hopefully this webinar, along with the others that we have done in the past and which we will continue to do, will start your journey to a better place and understanding of the issues and complexities involved. At the end of the webinar, I will signpost places where you can get further assistance. And to reiterate, this is not a beat-up session. We know that putting together a fair and balanced letter of instruction is not always easy. We also know that your clients understandably push hard to have their agenda and concerns prioritised. This can lead to you including questions, with the most frequent example being ring fencing, which you probably know as an argument may not succeed. One of the aims of our webinar today is to empower you to push back on some of those more spurious client claims. So writing your letter of instruction. So before we begin, I want to make you aware that we have a draft letter of instruction on our website. So if you are really stuck, then feel free to download this. Furthermore, our website also has several YouTube videos to which this will be added on this particular subject. Watch the videos, and before you know it, you'll be a pensions expert too. So why is the letter of instruction so important? Some of this may be stating the obvious, but I'll state it anyway. So the letter of instruction is so important because the questions posed set out the basis on which the pensions and perhaps other assets will be shared. Therefore, we need to be asking the right questions to get the right answers. The right answers will allow the divorce to progress. And if you imagine the Kubler-Ross change curve that we have used previously in presentations, will help settle negotiations and get the client back to what Kubler-Ross defined as acceptance and a return to meaningful life. Therefore, a good pension sharing report will allow both clients to feel that they have had their concerns addressed and that the settlement was reasonable to both parties based on the assets involved. So we think perhaps that a good letter of instruction looks a bit like this. So first of all, it's concise. The questions are incisive and not rambling. It's focused. The questions focus on specific concerns and issues. In other words, don't throw the kitchen sink at it. It's pragmatic. What pension resources are available to construct a settlement? A classic example of a question that may not always be pragmatic is asking for equality of income at 55. Ask yourself, how many people do you know that retire at age 55? Constructive, for example, is it necessary to have equality of income? Perhaps a target income figure may be more practical and agreeable to the parties. Allows for PODE input. We'll come back on this point later in the presentation. It acknowledges the types of pensions involved. As before, a little bit of knowledge goes a long way. Asking questions about income drawdown when the only pensions involved are public sector schemes is not relevant. Obviously, the contents of the letter of instruction need to be accurate. This is obvious, but we still come across letters of instruction where there are mistakes. Only a couple of weeks ago, a colleague highlighted an example of where the letter of instruction kept mixing up the applicant and respondent. So perhaps this is a good example of what should be included in a letter of instruction. And I'll just let these slides build here and let you just absorb those for a second. So I'll just pick out the key points from this. So firstly, you will note that the PODE has been given permission by the instruction to determine the correct age for equalisation based on the pension schemes involved. Secondly, the offsetting calculation request has stipulated a specific figure. Finally, and perhaps most crucially, the instruction gives the PODE free hand to comment on any other issues that a deep analysis of the pensions has thrown up. These may not be apparent at the LOI writing stage. In our opinion, this statement should be in every letter of instruction. So we won't spend too much time on this because a lot of it's obvious, but of course a bad letter of instruction is the mirror image of the good letter of instruction. And let me just pick out a couple of key points here. So one of those points is that a bad letter of instruction potentially promotes conflict, often inadvertently. So we find that asking too many questions often leads to conflict, as this can potentially polarize opinions and entrench positions. The classic example is calculating equality of income at several different ages. For example, 55, 60, 65, and state pension age. Naturally, each party will tend to gravitate to the calculation that suits them best. Finally, we do come across some letters of instruction that don't necessarily invite PODE input. And there have been instances in the past where we feel that we may have to bite our tongue about a particular issue. Thankfully, this is not the norm. And in any case, we would almost certainly reach out to both parties if we discovered something material to the calculations. Here's an example of where perhaps the instruction asked for too much. So let me just build this series of slides. So first of all, a question asking us to calculate equality of income. I think I should also just add at this point as well that it's perhaps unfair to pick on this one, as in the main, the individual questions are relatively concise. However, I've highlighted this as an example of where there are simply too many questions. Also, bear in mind that when the original fee quote was sent, it had been done so on the basis that only one equality of income calculation was being requested. Therefore, the original report quote was intended to be around £2,000. But as we can see, as I build these slides, that actually we've got the original equality of income request. We've then had two ring fencing calculations asked of us, and as you might be able to note there, that actually there was no agreement about what the actual ring fencing period should be. So we've got two separate ring fencing periods. We're then asked to do an equality of capital calculation based on those three scenarios as well. So already we're up to a number of calculations, as you can see as the slide builds. And then I guess the crowning glory of this particular request was the fact that we'd been asked to calculate all those different figures at least 4 different ages there. So I make that 20 calculations in total. Ultimately, the revised fee was £6,000. And interestingly, the parties agreed to that. But let's just spend a few seconds just thinking what perhaps could have been done differently here. So first of all, perhaps we could have used the dominant scheme normal retirement age rather than have 4 or 5 different ages. From memory, I think there was one very large defined benefit scheme involved with this, and it dwarfed all the other pension assets. So perhaps maybe using that scheme's normal retirement age, 65, would have been enough. Quality of capital, maybe not required. We'll have a look at this in a bit more detail later. And ring fencing with 2 different apportionment periods. Could we have met in the middle, perhaps? As a footnote, we understand that after receiving our report, it took the parties a further 6 months to decide on which calculation they would settle on. So the benefits of a great letter of instruction. I'll let you just read a few of those points there, and I'll just pick on a couple. So it provides clarity, it answers the questions and gives a good explanation for the conclusions reached. It speeds up the settlement. I'll refer to my earlier comments. Enhances the parties and their solicitors' understanding of pension matters, and keeps all costs down. These costs include the report costs, the solicitor costs, and possibly implementation fees as well. So writing a letter of instruction, which key questions should I consider asking? So equality of income and offsetting. I should also note that first and foremost, if you are unsure about which questions to ask, then we're more than happy to take your call. So clearly, if the conversation then goes beyond the facts, in other words, we're giving our opinion, then we could be conflicted and therefore unable to write the PODE report, but perhaps we can act as a shadow expert for your client on the matter. So I know I sound like a broken record here because you've heard this several times before if you've listened to a Blue Sky webinar. But an income-based question really is crucial. It is accepted that there may be some instances where you might wish to target a specific level of income rather than achieving equality, or even work a settlement based on an uneven split of incomes, perhaps 60-40. The key point remains, though, that the calculation should use the income generating potential of the pensions as the basis on which to work out the potential share. Offsetting, this is commonly a potential solution where there is a large pool of capital available to the parties, which could be more efficient and convenient than splitting pensions, particularly where it may be bad value to share pensions. So next are the questions that we think you should perhaps think twice before asking. We accept that there may be valid reasons to ask these questions on some occasions, and as you can see from the blue text box there, exactly what those ones are. So let's move on to what I would consider to be the pillar of every pension sharing report, and that's an equality of income calculation. So equality of income is in most circumstances likely to be the most relevant calculation. But let's just wind things back a bit just to understand what it attempts to show and why. So an equality of income calculation undertakes to identify the pension shares required today to provide equal incomes at a determined age in the future, typically 60 or 65. It should also attempt to match the income style of the two parties, for example, allowing for inflationary increases throughout retirement. When we say that the equalisation age is 65, for example, the exact point at which both incomes are equalised is the point at which the younger party reaches age 65. There may be some inequality of income up to this point, as the older party would have started receiving their income when they turned 65. So a quick tangent, try and avoid asking for a calculation that asks to calculate equality of income on a specific date, for example, one of the parties' birthdays. This may result in a calculation where the two parties collect their pensions at different ages, which may be considered undesirable. This might be considered to be an example of a perhaps not so good question to ask, and we've had instances of this being asked unintentionally, and what was actually meant was that both parties should receive their income at age 65. The reason that equality of income calculations are so relevant is because they are founded on the understanding that all pensions, irrespective of being defined contribution or defined benefit, are intended to be income-producing assets and not capital assets. Therefore, equalising income creates a common denominator between DC and DB, and so allows their income-producing potential to be correctly assessed. Thus, in cases where both DB and DC pensions feature, the equality of income calculation will be central to the matter. However, I'll challenge my thinking there on whether or not equality of income should actually be equality of benefits instead. And I'll give an example of why perhaps this is an even better question to ask than equality of income. This mainly revolves around revolves around instances where a defined benefit pension scheme confers the individual with a right to take a lump sum in addition to the income being generated from the scheme. So, for example, some older public sector pension schemes offered the right for an individual to take both a income and also an automatic lump sum of 3 times the pension income. So let's just work on an example here. So what we can see on this particular slide, if we look at the top 3 rows there, is we've got a husband with a £300,000 DC pot and projected income of £10,000 per annum. The wife with a £600,000 CE with projected income of £30,000 plus a lump sum of £90,000. So let's imagine that we were asked to equalise income. We calculate that actually to equalise income, a 33% share from the wife to the husband would be necessary to achieve equality of income. And you can see there, looking at the row 1 from the bottom, that incomes have been equalised at £17,500. However, what you will also note is that the wife continues to enjoy a lump sum of £52,500, but the husband has no such corresponding lump sum. So in other words, equality of income has been achieved, but not equality of benefits. So let's consider how this might look if actually an equality of benefits calculation had been performed. So in this calculation, we are carving out an entitlement for the husband to have the same lump sum as the wife, as well as equal incomes. In order to achieve this, there needs to be a 42% share from W to H to achieve equality of income and equality of lump sums. In other words, equality of benefits. You can see that as a result of this, income's actually been equalised at a slightly lower level there, but both have the lump sum of £45,000. Therefore, this really adds some weight to the argument that perhaps equality of benefits is a better question to ask than equality of income. So let's have a quick look at offsetting calculations. So in some cases, this is likely to be as important as an equality of income calculation, but what does it attempt to show and why? An offsetting calculation attempts to give a cash value to the pension income being given up by one party. In a Blue Sky report, our offsetting calculations are a secondary calculation derived from an initial equality of income calculation. So the first part of any offsetting calculation is to determine equality of income. This then provides us with the level of annual income potentially being given up should a cash lump sum be desired instead. Once we know the level of annual income being given up, we can then work out the capital cost of purchasing this future level of income with a lump sum today. Remember that in cases where the pensions are significant in value, it may be unrealistic to ask us to calculate a full offsetting figure, as there may not be capital available to implement this in practice, and the figure is therefore academic. If, for example, you know that one person is getting a pension of £60,000 per annum, then it may be unrealistic to fully offset such a large annual pension, and it is likely that a capital lump sum of around £1.5 million would be required here. Ask yourself, is it pragmatic and workable based on the assets of the marriage? However, it is possible to target a specific figure. Therefore, if the equity in the matrimonial home needs to be offset by an adjustment to any pension share, then this can be stated in the letter of instruction. A couple of additional points here. You will find that there is no consensus amongst PODES as to how offsetting calculations should be done. Our friends over at Matheson's have come up with the Galbraith tables, and these may be practical in lower value cases. We often see PODES give a range of offsetting figures, frequently with quite a differential between the lowest and the highest. At Blue Sky, we do a similar thing, but you'll tend to find, in our experience, we give a narrower range than many. So just to recap on some of those points about equality of income and equality of, offsetting. Equality of income, so stick to 1 or 2 retirement ages, typically 60 or 65. If in doubt as to what age to use, leave it to the PODE. state pensions should be included, and overseas pensions can be included, but remember that there may be problems as to how to actually share these. So it might well be that the conclusion from the PODE is to implement a pension share on the UK-based assets, taking into account any income received from an overseas pension. So offsetting calculations, a target cash figure can be very useful, and asking for 1,000 or 10,000 increments is unlikely to be helpful and potentially costly, and we'll dive into this in a bit more detail later. So moving on to some of those questions where perhaps it may or may not be relevant to ask, let's have a look at ring fencing first of all, otherwise known as apportionment. You can read at the top of the slide there that that's a direct quote from the PAG report, which is suggesting that ring fencing is unlikely to succeed in most needs cases. However, rather counterintuitively, we've seen a rise in these requests for these calculations since the PAG report was issued. We know that they are frequently client-led, and we have every empathy with you on this. A ring fencing calculation attempts to segregate the pre- or post-marital pensions accrual so that these funds can be excluded from the calculations. It can be very difficult to identify with any precision exactly what benefits should be excluded. For a defined benefit scheme, it is common to use straight line accrual, where it is assumed that a member accrued the same level of benefits every year that they were a member of the scheme. So, for example, if a member was in the scheme for 10 years and married for 5 years of those, very simply, 50% of the pension accrual is excluded. For a defined contribution scheme, we will try and identify what assets were accrued and when, and to understand what the current value of those assets are today. In reality, this is very difficult to do, and in some cases, this is impossible, especially if there has been a history of pension transfers. And I'll give an extreme example of this in a second. In circumstances such as this, we might have to resort to using the straight line method. So based on the comments that I just made there, you can probably tell that ring fencing calculations can be extremely tricky, and exact ring fencing proportions can be open to interpretation based on the data collected. So let's just have a look at an extreme example of where a ring fencing calculation request, seemingly innocuous, led us to some fairly dark places. So in this particular example, the letter of instruction was received in March 2019, asking Blue Sky to address various questions in relation to a Standard Life SIPP, which commenced on the 8th of October 2015 and was established by a transfer in from another pension scheme. So ring fencing calculations were requested, stating that the parties married on the 14th of June 2003 and separated on the 1st of October 2015. In other words, the current pension didn't exist at any point during the marriage. However, we knew that the Standard Life scheme was established by pensions that were accrued during the marriage. Understandably, Standard Life held no previous 1st of October 2015 premium information on their files. Therefore, at the point we were writing our report, we needed to track down the legacy schemes, which were ultimately transferred to Standard Life, and these schemes closed more than 4 years before the letter of instruction was drafted. One of the schemes we contacted didn't exist until 2006, and that particular scheme itself was the result of 3 other transfers in. We then had to go back to those original schemes, which ceased back in 2006, to get the information we needed to produce the calculations. Now, I've got to tell you that there was no reason why the pension provider would have retained the information from that pension, because they had no need to do so. However, very fortunately, the legacy schemes did still have records and were able to provide the information. But it took Blue Sky 7 months and a large amount of detective work to get to the answer. So a couple of thoughts that one might reflect on here. Firstly, at face value, a ring fencing calculation for a case containing one pension seemed relatively innocuous and straightforward. it was anything but. In fairness, the solicitor probably didn't realise the question would kickstart a chain of events that took 7 months to unravel. So as learnings from this, we can say with certainty that ring fencing calculations will definitely increase cost and are very likely to lead to delays. As a top tip, if you have a client with a large pension fund, typically a SIPP, and you are requesting ring fencing calculations, if you know that they have worked for several organisations, ask them if they have made lots of pension transfers. Ask them when they did the transfers. This might give us a head start with the detective work. And you can see from the slide there that Blue Sky recently issued a newsletter, which hopefully many of you read, about this particular subject. Right, moving on to equality of capital value calculations. So these calculations simply look at the underlying scheme CE values and suggest that pensions should be shared with reference to these values. The problem here is that pensions are income-producing assets and not capital. For a defined benefit pension scheme, it is worth reiterating that a CE value has no relationship with the income that will be paid from the scheme. The income promised by the scheme will remain the same irrespective of the CE value, which is largely influenced by economic and market conditions. And of course, many of you will know from clients that perhaps might have been disadvantaged by this, that over the last 18 months, 2 years, we've seen some very large falls in CE values from private sector pension schemes in particular. This has not affected the income that those schemes will pay, but potentially it has affected pension sharing implementation amounts. However, theoretically, a couple of a similar age, in good health, and with defined contribution pensions only could share their pensions according to equality of capital, and the outcome would be not too dissimilar from an equality of income calculation. This is because the CE values represent the true value of the underlying holdings. They have broadly the same time to go until retirement, and unisex annuity rates are applied. Where there are DB pensions involved, it is highly unlikely that sharing based on equality of capital is going to be the right approach. Please take particular care with public sector schemes where CE values are typically much lower than private sector schemes. A classic example of this is the police pension scheme, which we reckon is sometimes undervalued by as much as 3 times what the true value should be. And we look at fair value on the next slide, I think. Therefore, in almost all instances, an equality of income calculation will provide a fairer comparison, especially where defined benefit pension schemes exist. Let us look at a worked example to illustrate this point. So I know many of you would have seen this slide or a derivative of it before when you've listened to our webinars, but here we go again. It's a simple but illuminating example, I think. In this example, we can see that the wife has a DB pension with a CE value of £300,000, and the husband also has a pension with a CE value of £300,000, but in this example, he's got a defined contribution pension. So let's have a look at the benefits that the individual schemes confer on the members. As you can see, sharing based on equality of CE here would have led to a large disparity in income between the two parties. And I think this is the key point that we all need to recognise, and the potential result of sharing pensions based on their CE values. So let's now have a look at equality of fair value or fair value calculations. So a fair value calculation attempts to uncover the true value of a pension by looking at the CE value and asking whether it represents fair value. Given that a DC CE value is in most cases the sum of the underlying investments, then the fair value is the CE. However, for a DB scheme, it is unlikely that the CE represents fair value. Typically, fair value is evaluated by ascertaining whether the CE, in today's terms, will be sufficient to purchase the promised income at retirement age. In most public sector schemes, the fair value is a much higher figure than the CE value. It is much more likely for a private sector DB scheme to offer a CE, which is closer to the fair value. Still, most CVs aren't fair value. There may be some cases, however, where it is right to ask for a fair value calculation. Let's consider an example here. Imagine a case where there are a couple in their 40s and the only pension is an armed forces pension scheme, which has a CE value of £75,000. In other words, this is a modest value case and pension sharing could be costly to implement and value may be destroyed in doing so. Therefore, it is accepted that an efficient way to deal with this matter could be an offset based on the fair value of the armed forces pension scheme. In this example, the solicitor acting for the non-armed forces pension scheme member and therefore the likely recipient of an award would be right to ask for a fair value calculation so that an appropriate offsetting amount could be calculated. However, in most cases, a fair value calculation is not relevant and is mostly academic. In our view, an equality of income calculation will result in a fair value calculation being rendered irrelevant in most cases. This is because, to reiterate a point, the equality of income calculation automatically bypasses the CE and uses the income generation potential of the scheme as the true yardstick of a scheme's worth. So let's just summarize some of those key points from those 5 or so previous slides. So ring fencing, not supported by PAG, very difficult to be precise, can create conflict about what the apportionment period should be, and adds significant costs to a report. Equality of capital calculations. Very unlikely that pensions should be shared with reference to their CEs. May be relevant for modest defined contribution only cases where parties are of good health, similar age, and speed is required, but will almost certainly not lead to equality of income, especially when DB pensions are involved. So let's move on to some common sub-questions that often arise in our conversations with you all. So the first one is, what age to equalise benefits? You can see on the slide here that we've got an excerpt from that letter of instruction we saw earlier, where actually 4 or 5 different ages were requested in the instruction. So as a general rule of thumb, it isn't age 55. So we would caution against using age 55, and I'll go a bit deeper into that in a second. We are often asked whether using an earlier retirement age will be better for the party receiving a share. To this, I would say, in my experience, this is often the case, but not always so don't hold me to it. We think that multiple ages promotes conflict, and perhaps more tricky, not using scheme retirement ages can lead to us having to use these horrible things called early retirement factors or late retirement factors, which are effectively another layer of calculations that need to be performed, and we'll have a quick look at those in a second. I've put, actually, maybe we should consider letting the PODE decide. So in the particular example we saw earlier, you might recall that actually the right question probably was asked here, which was probably the second point there, which actually gave the PODE the empowerment to work out what the correct age for equalisation should be. So another sort of sub point on this really is that Blue Sky endeavoured to match income profiles. So in other words, if the schemes are coming in at different times, then we also try and build those steps into the calculations. And we'll often show a graphic, an example coming up in a minute when we look at state pensions, which also shows you how the incomes change during that period, typically from 60 to 67, when various different pensions come into payment. It's not always possible to match income profiles, as it depends on the pensions in question, but if it is possible, then we endeavour to do it. So let's just have a look at what some of the implications of asking for some of those ages might be. So first of all, let's have a look at the age 55 question. So having worked in pensions for over 25 years, I can't say that I've seen too many pension schemes with a retirement age of 55. We know that the earliest age that an individual can access a pension is currently 55, but going to my previous point around pragmatism, how likely is this? There may well be some additional challenges here, and I'll highlight one of those. For example, it's most likely that a defined benefit pension scheme has a normal retirement age of 60 or 65. Therefore, whilst the scheme may allow retirement at age 55, there's likely to be a relatively hefty penalty to do so. So this could, for example, be around 4% of the income for every year that the benefits are drawn early. Therefore, a scheme that has a normal retirement age of 65 with benefits taken at 55 could apply a penalty of around 40% of the income forever. So this means that additional data is required to do the report and additional calculations are required. Again, I go back to my previous point, is age 55 pragmatic? Moving on to equalisation at state retirement. Again, it's quite rare to see a pension scheme, or historically it's been quite rare to see a pension scheme that has a retirement age of 67. Most are 60 or 65. And in the opposite way to early retirement, if you draw benefits after the normal retirement age, then something called a late retirement factor is applied. However, I would question whether actually if somebody has an entitlement to a pension, are they likely to delay drawing on that for another 2 years if they can access the benefits without penalty? My experience would suggest that's not. And of course, as mentioned previously, the letter of instruction did actually ask what we would consider to be the right question. So state pensions, should I include? Well, I think I gave the game away a bit earlier because we said, yeah, you should always include state pensions. And here's just a graphic just to illustrate what the implications of not including state pensions might lead to. So it's very easy to obtain a state pension forecast online. Some of you that have been in pensions for a number of years will remember the horrible process whereby we used to have to send off something called a BR19 and hold our breath for 3 or 4 months waiting for the information to come back. That's not the case these days. We can all log on and get our state pension forecasts relatively easily. So the slide here illustrates the consequences of not including state pensions. On the left-hand graph, we can see a calculation where state pensions have not been included in the overall calculation. You can see how at age 60, equality of income was created. However, you can see by the divergence of the blue and orange lines at 67 that differences between state pension amounts have caused there to be a significant inequality of income from that point onwards. On the right-hand side, you can see a different approach. Here, state pensions have been included. You can see that the orange and blue lines actually diverge at age 60, and true equality of income is not achieved until 67 when the lines converge. From this point onwards, equality of income is achieved. A couple of key points on this. We can actually tell you what the difference in income will be between the age 60 and 67, so that there could be perhaps a small lump sum offset to make up for the difference in incomes between those points in time. In your letter of instruction, if you have identified that there are differences between the state pension entitlements of the two parties, then you could ask us to comment on this specifically and ask us if there are any actions that the relevant party could take to remedy any shortfalls in their state pension. Your client can easily print off data from the State Pension Forecast Service showing where they have shortfalls, and we can pass comment on how this could be remedied if possible. So moving on to common question number 3, asking for offsetting figures in, let's say, £1,000, £5,000 or £10,000 increments. This question is typically threefold. What will the offsetting figure be for say, each £10,000 increment? What will the impact on the pension sharing percentage be? What will the resultant decrease in income be for each £10,000 of offset? So look, going back to a point we made previously, offsetting calculations in our view should be based on pragmatism. Is there cash available to offset? Asking for increments can add considerable cost and provide a large number of figures which just simply aren't relevant. Sometimes we're even asked to specify a particular formula. But it's important for people to know, I think, that given the way offsetting is calculated, that the relationship between offset capital and the resultant change in income is not always linear. Therefore, it's not possible to simply say, for example, that giving up £10,000 of cash will result in a reduction in £1,000 of income. So there are a number of inputs into the pension sharing calculation. And as we have seen, blue sky offsetting calculations are an additional calculation on top of an equality of income calculation. Therefore, I think to reiterate earlier sentiments, it's better to specify whether a full offset is required or perhaps whether a specific sum is likely to be targeted. I think it's likely to be more cost effective for your clients if they ask for 1 or 2 offsetting calculations in the initial letter of instruction and then possibly ask us to produce an addendum later on once the couple have decided that offsetting is definitely the way to go. I think this can also speed things up as well. And remember that an addendum report won't be a full fat fee. It will be a few £100s to do those additional calculations. Whereas if you ask us to do the increment calculations, where perhaps there could be as many as 20, 30, 40 different sub-calculations, then the report will be the report fee, will be reflective of all those calculations. So do I always need the CE? And the answer here is possibly not, especially if you haven't requested equality of capital calculations. Let me just explain how this could work, for example. So let's imagine a scenario where the husband has pension benefits totaling £500,000 in CE values. The wife also has pension benefits. She doesn't actually know her CE value, as whilst she's requested it, the administrators of her pension scheme are suffering backlogs and won't be able to produce this for another 2 months. However, wife can access a benefit statement online, and this shows that she will receive a modest pension of around £3,000 from the scheme. It is therefore obvious that the direction of any share will be from husband to wife. We have all the CE values for the husband, and we know what pension entitlement wife has. Therefore, if you are asking us to produce an equality of income calculation, we can do this without needing the CE value for the wife. Common question number 5, is asking health questions relevant? Yes, a party's health is potentially a factor in the report. Therefore, health status should be considered and basic health questions asked at outset. Where a party suffers from potentially life-shortening conditions, Blue Sky will ask for a health questionnaire to be completed. This will enable us to request enhanced annuity rates, which can then be used in our report. Now, moving on to two potentially hazardous issues which you might have come across and which might keep you up at night. I'm going to talk about 2 highly topical, also very complex matters, which are likely to need addressing by a PODE. However, after providing a little commentary on each, I'm going to disappoint you all by saying that we are not going into more depth today. And I can almost hear your collective sighs of relief when I go into each topic. I am, however, going to explain what open-ended questions you may wish to ask a PODE about each matter in your letter of instruction. So first of all, let's move on to the lifetime allowance cap. So this is hazardous question number 1. So that there were some big changes announced to the lifetime allowance earlier this year in the spring budget. And just to remind you, the lifetime allowance is an effective cap on lifetime savings into pensions before additional tax charges apply. Since pension simplification in 2006, the lifetime allowance has been amended on numerous occasions, once going up to £1.8 million before falling back to £1 million. Ultimately, the point at which it's been abolished is 1.073 million and a few pounds. So every time government made changes to the lifetime allowance, various protections were introduced to allow some pension savers relief from new limits. This has led to a spaghetti-like list of rules and regulations, which means that having simplified pensions in 2006, pension legislation is arguably even more complicated now than it was pre-simplification. Those of you that thought that the lifetime allowance abolition meant that this question wouldn't have to be considered is wrong, because what's actually happened is that a cap on tax-free cash has been introduced instead, and this may catch people out and could be relevant for some calculations. Therefore, you may wish to ask a relatively open-ended question in cases where the pensions are large value, such as the following. Please comment on any issues in relation to the lifetime allowance which may impact on the calculations if relevant to this matter. It might not be relevant, but it's worth asking the question. Hazard number 2, the McLeod judgment. Arguably, this is even more thorny than the lifetime allowance issue, as it could affect many more people. However, firstly, a disclaimer. So those of you that have worked with Blue Sky in the past will know that we actually don't currently take on cases where a public sector pension scheme is likely to be shared. So the McLeod judgment specifically addresses age discrimination in public sector schemes. Of course, we frequently come across public sector schemes in our work where they are a small part of an overall larger pension pot. And of course, we are asked in our capacity as shadow experts for opinions on other PODE reports that do contain public sector schemes. Rather unhelpfully, I know, I do not intend to go into details here about the McLeod judgment or its impact on pension sharing. However, suffice to say that if you are composing a letter of instruction where a public sector scheme is involved, it is worth adding a catch-all statement in your letter of instruction along the lines. Please comment on any impact that the McLeod judgment may have on pension sharing. Once again, in some cases, it might not be relevant, but it's worth asking the question. So just aware of the time here, I'm just going to wrap things up. So we won't run through this scenario. I'll just move directly on to some of the conclusions. So understand what you really want to know so that the letter of instruction is focused and questions are limited. If you are unsure about an aspect of a case, call a PODE to discuss the pensions in questions and to discuss what questions may be relevant. I think this is a really key statement. Invite the pension on divorce expert to have input in your letter of instruction. So in other words, give the PODE free hand to make comments where they see fit. So a few action points from today. I know many of you would have done, but if those of you that haven't, read PAG. There is a copy of it on our website. We also know that PAG 2 is coming in the new year. And of course, when that comes out, we'll be inviting you all to a webinar around that. Look at the Blue Sky website. We've got a wealth of resources on our website, which include YouTube videos, fact sheets, and all sorts. Use our letter of instruction template if you're really stuck. Sign up to our newsletter so we won't bombard you with lots of irrelevant issues. We will send you a monthly newsletter which focuses on a particular topic. And perhaps you might want to consider inviting us to a training session for your team. So we are very happy to do either a Teams presentation or perhaps come into the office and do an in-person presentation where we can perhaps dive into some of these issues in a bit more detail. So I know that we're a bit up against it. We've got 7 minutes left today. Just before I do have a look to see if there are any questions, I would like to just highlight Rob's session next week, which will be on Wednesday at 2 p.m. So that's Wednesday the 6th. This session will cover cash flow modelling and how it can be used at multiple stages of the divorce process. You know, in our opinion, proper financial planning cannot be achieved without cash flow modelling, and our knowledge of using cash flow modelling over the last 15 years means that we have applied it to the divorce process many times, whether that's mediation, collaboration or collaborative, settlement for stress testing, or rebuilding mind and finances post-divorce. We think that it can be an absolutely fantastic tool to help your clients reach settlement, and would urge you to please listen in on that. So that's me done for today. I don't know if we have any questions. Rob, perhaps you can let me know if there are any questions. So just looking at the Q&A now. Can't see any open questions. Still got 5 minutes. So if there's anything anybody would like to ask, then please feel free to ask the question now. Otherwise, please feel free to email me after today's meeting, and happy to get you signed up to the newsletter or answer any additional questions that you may have.
Thank you, Jeremy. That was a good session. Lots of questions answered by Jack and myself as we went along, which was great to see. and some really positive comments on how that went today, Jeremy. So thanks for that. I tell you what we'll do. Why don't we keep we'll keep the session open till exactly 12 o'clock. So there's 3 or 4 more minutes. Anybody wants to hit us with questions, go for it. There's 3 of us poised to answer if you fancy hitting us with questions. Thanks, Emily. I suppose if you had a situation where they definitely earned exactly the same amount of money through their working careers, then possibly there would be no need for a pension sharing report. But I would say that that's still a pretty rare scenario. So I think you probably definitely, I think, would you agree, Jeremy? I think the teacher's pension is so nuanced. I think you'd want that. I think you'd want a report every day of the week on a teacher's pension. That would be my opinion.
I think so. I think it'd be key to understanding what the teachers' salaries are, and then being pragmatic about it. If there's a big disparity in the salaries that they earn, then clearly there could be a big disparity in the pension entitlement that they've earned. So that's the key thing. I think that's the next layer of questioning, maybe, Emily, that you need to think about having with your client and your client's spouse. But potentially it could be quite an effective and easy way just to do an offset, should there be not a great deal of difference in the 2 incomes.
Thanks for the question, Emily. Hi, John. That's a great question. And we always would encourage that 4-way meeting. That's going to really help the process massively. Get your expert involved in the session. No question about it.
Yeah, I think also, John, I think I would mention that we can and do that on quite a regular basis with solicitors as well. So we are happy to have 3-way Teams meetings where there are issues that need to be ironed out before the letter of instruction can be written. So I think that's a great point to make. Well, everybody, I can see that quite a few people have disappeared to go and get their sandwiches. So at this point, I think we'll call it a day. But yeah, do get in touch with us at Blue Sky. You'll find that we're a friendly bunch and happy to help. So anything pension sharing related, think Blue Sky and just pick up the phone. And once again, thanks very much for taking the time out of your busy diaries to listen into our webinar today. Thanks very much. Thank you.